How's it going, people? Welcome back to the Crunching Numbers YouTube channel. Today we'll be taking a look at bond amortization, specifically focusing on the effective interest method. So whether you're studying for the FAR CPA exam or an intermediate accounting class, then this is definitely the video for you. First, we'll start off by giving a very broad overview on exactly what bond amortization is, followed up by some of the important journal entries to remember. Then we'll be going over the specific steps involving the effective interest method. After that, of course, we'll be going over some specific examples to really understand and grasp how to use this effective interest method. Of course, if you want to skip right to those examples, I'll leave a timestamp below for you. But that being said, let's jump right into the video. So what exactly is bond amortization? Well, when a company issues bonds, very rarely do they issue it at its face value. They either issue it at a discount or a premium. In the case of a discount, they're receiving funds less than the face value, or in cases of a premium, they're actually receiving funds greater than its face value. So this bond amortization is just reducing that bond discount or premium payable by allocating a portion to interest expense over the remaining life of the bond, thus pulling that carrying value of that bond closer to its face or par value. So in the cases of discounts, the unamortized discounts reduce the carrying value of the bond when issued, so these amortized amounts increase interest expense each period, thus pulling up the carrying value of the bond closer to its face value. On the other hand, in the case of premiums, unamortized premiums increase the carrying value of the bond. So in the case of amortized amounts, they actually decrease interest expense each period, thus pulling down the carrying value each period closer to the bond's face or par value. Now let's take a look at the two most important journal entries involving the effective interest method and bond amortization as a whole. Remember, as long as you're able to remember and understand these journal entries, it will really help you solving a majority of problems involving the effective interest method. So first, let's start off by taking a look at amortization of the discount. Of course, for each of these, we're going to want to debit interest expense. And in the case of a discount, you want to credit out discount on bonds payable and credit cash. The reason we're crediting discount on bonds payable because upon the issuance of a discounted bond, we're debiting that discount on bonds payable. So when we amortize, we want to slowly reduce that discount on bonds payable, thus pulling the bond closer to its face or par value. In order to do that, we must credit out the discount on bonds payable. Likewise, for amortization of the premium, again, we're debiting interest expense. However, in this case, we're going to debit that premium on bonds payable because upon issuance of a bond at a premium, we're actually crediting that premium. So in order to amortize, we want to debit that. Next, we want to credit out cash. And again, we're just crediting out cash for the amount of the interest payment that's due on the bond each period. Now, how exactly does this effective interest amortization method work? Well, it can be broken down into three simple steps. Number one being determine the interest expense for the current period by taking 1, the current carrying value of the bond, and multiplying it by 2, the effective interest rate. And again, both of these amounts should be given in the problem to you. Next, we're going to want to determine the recurring interest payment by taking the face value of the bond and multiplying it by the stated interest rate. Again, these amounts should be given to you right in the problem. And then finally, all we're going to want to do is take that difference between the interest expense that we solved in step number 1 and the interest payment, which we solved in step number 2, and that's the amount to be amortized for that period. So again, taking the interest expense and finding the difference between the interest payment, that's the amount to be amortized. And in the cases of a discount, of course, our interest expense will continually be rising. And in the case of a premium, our interest expense will continually be decreasing. So that being said, let's jump into some examples. So example number 1 here, an effective interest discount. During the problem, Bowling Corporation issued a 10% $500,000 bond due in 5 years' time. The bond sold for $465,000 on January 1, year 1, at a market rate of interest of 12%. Interest is to be paid every July 1st and December 31st. Quickly taking a look at what they're asking us to calculate. 1, the journal entry to record the issuance of the bond. 2, the journal entry to record the first interest payment. And 3, journal entry to record the second interest payment. So just taking a look at the problem here, highlighting some important concepts we're going to need to answer these questions. It says Bowling Corporation issued a 10% $500,000 bond. So this 10% is our stated interest rate, and this $500,000 is the face value of the bond. However, also in the problem, it says what the bond actually sold for. So the bond sold for $465,000. Of course, that's going to be our carrying value of the bond. And if we keep reading, it says it sold it at a market rate of interest of 12%. This market rate of interest just equals the effective rate of interest. They're essentially the same thing. So now, with that, let's jump right into our first question here. Journal entry to record the issuance of the bond. So taking a look at our solution here, in order to do this, we want to take the bond face value, which was given in the problem at $500,000, Subtract out what the bond actually sold for, i.e. the bond price at $465,000, which was also given in the problem, to find out the discount on the bond at $35,000. So, of course, to record this issuance, we're going to want to debit cash for the amount the bond actually sold for at $465,000, record a debit on the discount on bonds payable, which we just solved for at $35,000, and of course credit out the bonds payable at $500,000, its face value. We're always crediting it bonds payable upon issuance at its face value. Next, let's take a look how to solve for the first interest payment on this bond. Remember, this just comes down to remembering those three simple steps that we went over on the previous slides. First one, to determine the interest expense. So what we're going to want to do is take the bond carrying value, which was given in the problem at $465,000, and multiply it by its effective interest rate. Here we have 6%, because if we remember, if we take a look at the question here, it says that it was at a market rate of interest of 12%. However, interest is to be paid every July 1st and December 31st. So there's two interest payments during the year. So of course, when there's two interest payments, we're going to want to divide that interest rate by 2. So that's just the 12% divided by 2 at 6% to get our interest expense of $27,900. Next, to figure out our interest payment, again, this is just taking our bond face value, which was given in the problem at $500,000, multiplying it by the stated rate given at 10% to get our annual interest of $50,000. But of course, if we remember, interest is being paid out twice a year, so we're just going to divide that by the number of periods at 2 to get each interest payment at $25,000. Now, the last step in this is just figuring out the actual amount of amortization, which, if we remember, is just taking the difference between the interest expense and the interest payment. So, of course, our interest expense, which we just calculated at $27,900, subtract out our interest payment at $25,000 to get the actual discount amortization of $2,900. So, of course, to record this, it just comes down to remembering those journal entries that we went over. We're going to debit out the interest expense at $27,900, credit out the discount on bonds payable at $2,900, and, of course, credit out cash for the amount of the interest payment at $25,000. Just a key thing to remember when using the effective interest method of bond amortization involving discounts. Upon issuance, it's going to be a debit to discount on bonds payable, but when you actually do the amortization, you're crediting out that discount on bonds payable. But that being said, let's jump into the third and final question. So in order to solve this question, what you have to do after each and every interest period is calculate a new carrying value. So in order to do that, all you're going to take is the old carrying value, which we started off with at $465,000. And in the case of discount amortization, you want to add that amortization to the carrying value. So our old amortization was $2,900 to get our new carrying value of $467,900. Remember, in premiums, we're going to subtract that amount. We'll take a look at that in the next example. But just remember, in cases of discounts, you're adding that amortization to the old carrying value to get your new carrying value. So now that we solved that, we can solve our third and final question here. The journal entry to record the second interest payment. So again, just following those steps, first we're going to want to solve for interest expense. So we take the new carrying value of our bond at $467,900, multiplied by that same effective rate at 6%, and we get interest expense of $28,074. Of course, we already solved for our interest payment, which we know is $25,000, so we don't need to solve for that again. The interest payment will stay the same throughout the life of the bond. And our third and final step is to find out the actual amount of discount amortization, which again, if we remember how to do that, is taking our interest expense of $28,074, netting out our interest payment of $25,000 to get the actual amortization of $3,074. So of course, same way to record this is debit interest expense of $28,074, credit out that discount on bonds payable of $3,074, and of course credit out cash for the amount of the interest payment at $25,000. So that's the example surrounding discounts for the effective interest method. Next, let's take a look at how we would solve a premium example. So reading the question here, Bullen Corporation issued a 10% $1 million bond due in 5 years' time. The bond sold for $1,100,000 on January 1st, year 1, at a market rate of interest of 8%. Interest is to be paid every July 1st and December 31st. Now quickly taking a look at what they're asking us to calculate. 1, the journal entry to record the issuance of the bond. 2, journal entry to record the first interest payment. And 3, journal entry to record the second interest payment. So relatively the same items. So, of course, we just want to note some important things in the question here. It says that they issued a 10% $1 million bond. Of course, we know that 10% is our stated value, and the $1 million is our face value of the bond. Next, it gives us what the bond actually sold for, i.e. its carrying value. which was $1,100,000, and it was at a market rate of interest of 8%, which again, we know market rate of interest equals effective rate of interest. So jumping into the first question here, journal entry to record the issuance of the bond. In order to solve this, we need to find out the actual amount of premium that the bond was issued for. So we take the bond price at $1,100,000, subtract out the bond face value of $1 million, which again, both these numbers should always be given into the example for you to get the premium of $100,000. So again, to record this issuance, we're just going to debit cash for the amount received for the bond, which was given at $1,100,000, credit out premium on bonds payable, which we solved to be $100,000, and credit out bonds payable at $1 million. I know that says $1,100,000. That should just be $1 million. Next, let's solve for the journal entry to record the first interest payment. Again, just remembering those three simple steps. First, solving for the interest expense. Second, solving for the interest payment. And then netting those out to find the actual amount of amortization. So we start off by taking our bond carrying value at $1,100,000, multiplying it by the effective rate at 4%, which again, if we remember, it was given 8%. However, it also says interest is to be paid every July 1st and December 31st, so twice a year, so we divide that by 2 to get our interest expense at $44,000. Next, to solve for our interest payment, we take the face value of the bond at $1 million, multiply it by the stated interest rate at 10% to get our annual interest of $100,000. But again, there's 2 interest periods for the year, so we divide that by 2 to get each interest payment period of $50,000. Finally, let's find out the amount of the actual amortization itself by taking the amount of the interest payment at $50,000 and subtracting out the interest expense at $44,000 to get the actual premium amortization of $6,000. So in order to record this journal entry, we're going to debit interest expense for $44,000. We're going to debit out premium on bonds payable. That's the actual amortization taking place for $6,000. And of course, credit out cash for the actual interest being paid at $50,000. Again, just on the other side of a discount, in the case of a premium, when you're issuing your bonds, it's going to be a credit for a premium on bonds payable. But when the actual amortization takes place, you're debiting that premium. So in order to solve for the second interest payment, again, we have to calculate a new carrying value. So in order to do this, we just take our old carrying value at $1,100,000. And in this case, for premiums, we subtract out the amortization. So we would net out $6,000 to get our new carrying value of $1,094,000. Remember, in the cases of a discount, we're adding this amortization. Just remember, in cases of a premium, you're subtracting out the amortization to get the new carrying value. So again, to record this second interest payment, it's just following those 3 simple steps. First, solving for our interest expense here, taking the new bond carrying value of $1,094,000, multiplying it by the effective rate of 4% to get our interest expense of $43,760. Again, we already know our interest payment to be $50,000. Interest payment stays the same throughout the life of a bond. Next, we're going to want to find the actual amount of the amortization itself, of course, which we take the interest payment, net out the interest expense to find that premium amortization. So we take the $50,000 for our interest payment, subtract out the interest expense at $43,760 to get our premium amortization of $6,240. So of course, to record this, we debit out the interest expense of $43,760, debit out the premium on bonds payable of $6,240, and credit out cash for the actual interest payment being made at $50,000. So with that concludes our video on the effective interest method of bond amortization. Remember, as long as you're able to understand the journal entries as well as the 3 simple steps and actually apply them to the examples given in this video, then you should have a pretty good understanding of the effective interest method. With that being said, I'll leave you with a question of the video. So in example 1, if the stated rate of interest was 14%, what amount would be amortized for the first interest payment? Remember to leave your answers in the comment section below. I'll pin the first one that I see correct at the top. Also, in the comments below, leave what videos you would like to see me make in the future and what topics you're interested in involving accounting. But that being said, I hope you enjoyed this video, and I hope everyone has a good one.